Okay, let's do a notes payable example. So I want to go through this notes payable in a little bit of detail. Okay, so on October 1st, Fitzy Company signed a $5,000 3-month note payable due January 1st with a 6% interest rate. Remember, interest is always stated as always for a year, even if it doesn't say annual beside it, unless it says something different. So if you see an interest rate, you are assuming it's for a year, which is why we need to take into account how many months we've had this note. So we've had this note is for 3 out of 12 months. That means we have to pay it back on January 1st. So January 1st, due 3 months after October 1st. So there's a couple things we need to take into account. In this particular example, let's assume the year end is October 31st, which means we need to do an accrual to record the interest expense that we will owe at the end of this note so that that interest expense ends up in the proper year, not the following year. Okay, so I'm going to kind of jump around here. I'm going to skip down. Here is the formula again to calculate that interest rate. It's the face value of the note times the interest rate times time. Now, in this particular case, the year end is October 31st. So 1 month we've had it. So we owe $25 worth of interest. So basically, on October 31st, the accrual, this is the adjustment, it's also called an accrual, needs to record the interest expense. So $25 we need to include for an expense, and therefore we owe it. Remember, we never use cash in an adjusting entry because we're not paying it. We owe it. So that's interest payable. Now I want to take a step back here first because I didn't show you. This is the adjustment, and this is what we're studying right now, adjustments. But with respect to notes, I want to be clear that there are a couple other journal entries that you're going to be responsible for knowing, and now is a good time to do it as well. So what is the journal entry on October 1st? So these are just journal entries. So on October 1st, we got the note. So it's a cash, let's say. We got money, for $5,000, and the credit is going to be notes payable. This is how we record it. We borrowed $5,000, we owe it, we signed a notes payable, which means we are going to follow these terms. And then on October 31st, so this would be our first journal entry, this would be the adjustment that we do at the year end. And then it's really important to talk about what we do when we pay back. So the third journal entry on January 1st, when we go to pay this back, well, let's think about what we know. Well, for sure, we know we owe 3 months worth of interest. So, and we also know we're going to pay back the entire note. So I'm going to debit notes payable for the entire $5,000 because we're going to pay it back. I know we have to incur or record 2 more months of interest expense because we have 3 months of interest expense, but we've only recorded 1 month so that it would fall into the year before. But we do have 2 more months of interest, which is $50. If you do 5,000 times 6% times 2 over 12 in this case, you'll get 50. And we're paying back this interest payable, so we're going to have for 25. And now our cash is going to go down $5,075. Okay, so with respect to this notes payable, 1, we record the note when we get it. 2, if a year end falls in the middle of it, you need to accrue the interest. So this is our adjusting entry, and this is the payment day. we need to pay, including the interest. Okay, now, just so you know, if there was no year end after this, or in the middle of this note, we would have had just this journal entry. And on January 1st, we would have just had notes payable. We would have had interest expense of the whole amount, and cash would have been. But because there was a year end in the middle of this, we needed to accrue interest that we owed in that time period. Okay, so now let's look at a salaries example. Okay, let's talk about salaries. Salaries is another example of an accrued expense. And they're a little bit tricky, so I'm going to go through this very carefully with you. Here's an example. I have an employee, and she began work on Monday, July 15th. Ignore my dog. And she was last paid on July 26th, and she's going to be paid again on August 9th. So let's look at a calendar. I have a calendar down here. It's really important. I encourage you to look at a calendar. So she started work on July 15th. She was last paid on the 26th. And let me go back and see. And she'll be paid again on August 9th. So if you look at this then, you will see, let's put the days on here. Monday, Tuesday, Wednesday, Thursday, Friday. And assume this employee does not work on weekends. So that's 2 weeks between paydays. Okay, so she started here, she's been paid, and now she has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 more days until payday. However, the year end, which is always the problem, falls on July 31st. Now, as you know, at the year end, you need to do accruals, adjustments to bring accounts up to date. And we have an expense here, an accrued expense that we need to record. So we have a salaries expense. So she was last paid here, so we know it was recorded then. And there's 1, 2, 3 days that we're going to owe this employee for. So we owe 3 days. So if you think about it, 3 days times $100 a day. If you recall, she makes $100 a day. On July 31st, the salaries for the last 3 days is an accrued expense. She makes $100 a day. So our journal entry, this is our adjustment or our accrual. We have an expense of $300 and we owe it. We're not paying the person. Remember, payday is not till later. And the next payday is August 9th. So that's the accrual. That's what we're focusing on right now. But what is the payday going to look like? This is payday. Well, we owe them $1,000 because remember, they worked 10 days between paydays and it was $100 a day. So cash is going to go down $100. That's simple. We are going to reverse the salaries payable here that we have because now we're paying them. We no longer owe them. So we're going to debit salaries payable. And then we have 7 days left of expense that we need to record. So $700 there. Okay, just to recap now, adjusting entry. So we had accrued revenues. You're going to debit an asset and you're going to credit a revenue. And for accrued expenses, you're going to debit an expense and credit a liability. So just to recap here, for example, rent, the accrual for rent revenue, an accrual for rent revenue would be accounts receivable or rent receivable, and it's going to be rent revenue that you need to record. Here, let's use notes payable as our example to recap. with respect to notes, you have interest, remember? And so we will have interest expense. So see, it's an expense, and we're going to have interest payable that we owe. So we're going to credit a liability. Now, remember, if we do not do these, if we do not do an accrual for revenue, we're going to have our asset understated and our revenue will be understated. If we do not do an accrual for expenses, our expense will be understated and our liability will be understated. So by now you should be able to know the two types of accruals, be able to explain the effects of not doing accruals. We just did that overstated, understated thing again. And prepare the adjusting entries for both of those accruals. Thanks for watching and see you next time.